Now to our next guest, who's seeing some warning signs of a market top, unless Ben Bernanke can save the day. Keith Springer, president of Springer Financial, he joins us now to talk a little bit more about the market, which is down today and has been selling off. So the point is, you think it could continue to go down unless, the helicopter flies in and, the propellers are going crazy and the money starts flowing again. And that will happen, you think?
Well, that's what's going to happen, Connell. You hit it right on the head. The market is sitting on a sea of liquidity. Every time we don't get a QE, the market tends to drop. We sell off. Dollar rises a little bit. Bernanke comes in, saves the day, and that's where we are again. The market is looking a little old and tired here. We're in the 40th month of this bull market. Bull markets typically last 39 months. When the fourth year of a presidential cycle, that's usually the peak in the market. Start going down in the first year. The president isn't going to have a whole lot of political will to stimulate and borrow to stimulate after the election, so I think we could be seeing a top, although a QE3 is going to save the day for sure.
All right, what's it going to look like, and what should we buy? I mean, the obvious things with this would boost the stock market if you're right, but what is the timing in all this? Commodities would go up, I'm sure. Is it just a bond buying program like we've seen, or is it some sort of a, under the radar type of a stimulus from the Federal Reserve? What will Bernanke and company do? What should we look for?
Well, most likely it's going to be another bond buying activity. You're not going to know exactly. He never calls it a QE anything. It's always by a different name, but most likely it's going to be an injection of liquidity in some way. The market loves it. The market speculates with it. You're going to see it probably closer to the election, maybe, get a little push. Some sort of bond buying activity. We're having a little drop down now after earnings season. It'll probably pop up a little bit as we get closer to earnings. We've just got to keep in mind that the market's looking a little tired. Investors should focus on income, dividends. I mean, that's what we do for our clients.
How does the Fed rationalize it, though? Maybe it just says, hey, Europe has become such a problem or something like that, because, there's been a lot of criticism. Maybe the Fed has already done enough of this and shot all the bullets in its gun and all that kind of thing.
Well, what we're seeing is a slowdown in this economy, Connell, at the same time. We're seeing the QE starting to wear off. QE2 is now starting to wear off. QE programs take 6 to 9 months to feel the effect, and then they last for 6 to 9 months. So sometime around now, in the next couple of months, you're seeing our economy start to slow down. Bernanke gave us a warning a couple of months ago. He said that if I see a slowdown in this economy and I see inflation get back to around 2%, and that's inflation for people who don't drive and eat, which is kind of strange for all of us. But that's what he's looking for, so he can pump a little bit more liquidity into this. It's almost like a Bernanke put. He keeps wanting to put a floor under the market. He thinks that by putting more money into this economy, it's going to keep it afloat. Essentially, we just have a slowing economy. We have a large demographic problem. We've got aging baby boomers who are past their peak spending years, massive debt problem. I mean, just look at the housing market. You have, the 10-year below 1.8 now, and you're going to have mortgage rates going even lower.
It's crazy.
Even that's not spurring really any growth in housing. So what we're seeing, Connell, is just a slowdown from the economy overall, and Bernanke is probably going to have to continue injecting money until the interest rates go up to the point where he can.
All right, thanks, Keith. We appreciate it. Keith Springer from Springer Financial with us today as we get to a quarter
Thank you,
until the hour.